Welcome to TradeTheMBI.com. This is John's report is for the 6th of October, and pretty much we stayed right within the range that we were expecting. Both a lot of up and down, but still pretty much straight across. And that was a suggestion we had from our DOC readings, where our orange was just captured between cyan and red, which is continuation. Shakeout not improving so much, meaning like we figured there would be some accumulation as new fund money came in, and it's fully arrived. So what they start applying it towards really becomes significant at this particular stage. That it's right at a previous algo level where they, made their attack back in June. That caused the uplift up towards the, near 4,700 range. Not surprising. We're still looking at a positive move here from MBI Magenta, so that's enough to give it some strength. We would expect to move back towards that 43.22 range, and it's just a question of do we get a spike back up of the DOC orange, because that would be enough to cause problems. The difficulty is your short-term buyer is pretty much extended, so this is all going to have to come from real legacy money that wants to drive things higher. Is that a likelihood given what we're seeing? Well, of course, you've got unemployment and those details coming out later today, and that's going to give the market a little bit of a hint as to whether or not the increase in interest rates is starting to really have a significant bite. We've already seen it from a consumer spending standpoint, the slow off in September, and will that be enough to cause the Fed to abate and stop its action? Of course, we know that that's more tied to what oil does than anything else, and that becomes more of a significant factor than anything. From an NQ standpoint, it was already stronger, just in general. And you can see we're moving again with the DOC right here, much tighter spread between the cyan and red, so that range is a bit narrower, and you have the orange right back in between it. But again, no reset of short-term buyers here from the steel, so that usually indicates a little bit tougher road to really propel things going forward into the upside of it. And that 23% on the Nasdaq has really been a resistance factor at this particular stage, so not a surprise there. And also, we note that well, from a positive extreme standpoint, literally starting with this bar right here, you can see that we were much stronger from an NQ standpoint than we were with the S&P, because it never came back to fill completely. So that puts a downside potential to it, but the S&P being much broader and stronger is usually the one that we focus on first. From a primary view. And you can see from a treasury standpoint, yields still very attractive. It makes it very difficult to justify wanting to press into the market when you can get a significant enough yield, particularly if you're able to watch oil and you see this kind of setup. So we knew that there were positive extremes for oil going all the way back to the setup they've now filled. Now it becomes a question as to whether or not this continues to the downside, if there's a significant slowdown in economic growth and the demand has trailed off dramatically, or if it's just the normal correction within the up push that took place. That becomes significant leading indicator. But this drop in oil certainly is a plus for the market, because it softens the inflationary pressures to a degree, and certainly will head off a lot of it, but does not give the Fed any impetus to do anything other than maintain things where they're at. And this is something I said when we were back up here, that they had to get involved and bring oil down in order for the Fed to be able to maintain its posture as it is, and miraculously that happened. Who knew? That also decrease in oil, as we talked about, benefits the euro, because again, as oil is traded in dollars, and if you have to spend a lot of euros to get dollars, it's just a capital drain. So this is helping also support euro from that standpoint as well. So we can see that as oil goes, it's going to affect everything. The fact that we're still not seeing any move from gold is surprising, particularly if there are soft economic numbers, and that gold should be really taking a major push. So you know that there's some significant activity keeping gold from becoming a factor at this particular stage. But that is also not to the same degree affected your cryptos. They've had a lot of other issues unrelated to any of these things. But the fact that you can get a significant yield from treasuries now, crypto becomes a lot less attractive. unless you're literally trying to just get out of the monetary system in general. And you can see even from ETH, a big struggle as far as that goes. So the crypto winter, as they described it, still a real thing. Intraday, you can see we started up peak, came down to 50%. That became very attractive funds, and they jumped right in there and bought that up, and are continuing to do the same right now. Actually getting a strong dip of DOC orange below the red right there, potentially would be enough to really propel things back and start getting up into the upper range in that 43.20, which would take us exactly right back to where the original algo from a daily standpoint. So you can see all the confluences of events are all pushing towards the same reality of wanting to push somewhat higher within the current construct. So we see from a 5-minute chart what happened the other day. We started off with some weakness, and then that just bled down. And then once there was enough clearing of all the stops in that, there really wasn't any new supply, and that led to the pushback up to get that finish towards pretty relative even for the day. And then you can see here in the post market, we're already making a significant push. They checked to see if there was any supply to the south. There wasn't, and it's been straight up from there. So this is the anticipation that things will be positive from a read standpoint, but I would still expect the potential of some back and forth within the current day action, but clearly the bias is tilting a little bit more to the upside. And this is something that we expected as we were rolling into the beginning of the month with new fund money, and that it usually is enough to push it, whether it's sustainable as we get towards the middle part in that, and whether or not the economic numbers justify continued strength in the economy. That becomes a far more significant question at this particular stage, and those are what we'll be looking for, like everybody else in that sense. But we'll see it from a reading standpoint earlier than most, and that's always the positive. But certainly an interesting time, because the Fed has done an excellent job in this standpoint of normalizing rates. Now, what they do from here, the question is, are they going to be too aggressive? Most likely they've already been too aggressive, and but they have really sucked up all that excess liquidity from the COVID era, which really makes a more neutral stance. So you don't have that excess liquidity and the cost of money returning back to normal periods, which is an anomaly for most people, given that you had a decade where they were just outside of the normal range. So we're going to really be into a transitionary period here coming forward, and I think that's going to just add to our volatility, both the upside, downside, both, which as long as we have our readings that give us the right signal, we don't care. So that's the long and the short of it for now, but it should be another exciting day. As always, though, look for me on the Skype chat. Trade well.